Well, the Monetary Policy Committee of the Central Bank of Nigeria is set to announce its decision for the second MPC meeting in the year 2020 amid fears of escalating tensions arising from the spread of COVID-19. In line with a global trend where several systemic central banks have been announcing various stimulus packages to whistle down the debilitating effect of the virus. The CBN also recently announced stimulus packages to support vulnerable sectors and stabilize the various macroeconomic frailties that are crystallizing off the back of recent COVID-19 pandemic. Consequently, the decision of the March 2020 meeting, which is expected, should further address other monetary policy actions that can ameliorate the vulnerabilities of the economy, leaves much to desire. And joining me now to preview the outcome of today's MPC is the Vice President Investment Research, Robert Omotunde. Thank you very much, Robert, for coming on the show.
Thank you.
Well, of course, you will agree with me that this meeting is a defining one for the economy, especially since we had the first index case of the COVID-19 pandemic. Now, how will you assess the development in the macroeconomic space since the last MPC?
Yeah, I mean, I think, like you said, it's going to be a defining meeting between the last MPC meeting and now. I've seen various developments within the macroeconomic space. We've seen the GDP figure for 2019, Q4, which showed that it was quite stronger. That was after the IMF projected that growth expectation was expected at 2%. We've also seen inflation figure, which suggests that the effect of border closure is still being felt. I mean, we're talking about inflation printing at 12.2. That's the headline inflation. We've seen trade data, which has also suggested the much of volume of imports, coming into the country, where you've seen that we've recorded, negative. I mean, we've seen trade deficit more or less, looking at the Q4 data, and then the effect of COVID-19, has also impacted a whole lot, especially on the stability of the foreign exchange market. Between the last MPC and now, we've seen the much of plummeting that the global oil prices, have recorded. And this has direct implication for macroeconomic stability in Nigeria, given our dependence on oil. And we've also seen some of the measures that have been put in place, both from the fiscal authority, the budget assumptions, for example, have been revised. I mean, we've seen cutting down on budget by up to 1.5 trillion naira. We've seen other announcements from the central bank, part of the stimulus package for the vulnerable sector. So, but I think that, like you said, I mean, if you look at the development within the global space, where you've seen different global systemic central banks, announcing different stimulus packages, I think that this meeting, for example, U.S. Fed had to, announce an emergency. They had to have an emergency meeting, for the first time when the interest rate was first reduced by 50 basis points. We have not had an emergency meeting, again, possibly because, there are limits to what monetary policy can do in this climate. But the much of what we've seen is the announcement of the different stimulus packages. So definitely, it's a very important meeting, and I think the committee, we have to make a pronouncement, further possible stimulus, maybe that can help, stabilize the macroeconomic indicators within this, this very challenging time.
Now, some of these interventions that we have seen the central bank come up with, do you think the steps taken so far are appropriate?
Well, I think that, if you look at the mandate of this central bank, it was after the central bank governor got a second term that we've seen a 5-year agenda, for this central bank. And the central bank has been more tilted towards, towards providing intervention. Even before the outbreak of COVID-19, you see a lot of intervention funds, which summarize for up to, if you sum up all the intervention funds, that the central bank operates, from the PAVE, that's the Power and Airline Intervention Fund, to the, RSSF, that's Risk Sector Support Facility, to the Anchor Borrowers Program, the MSME funds, the Restructuring of Facilities Fund to the manufacturing sector. All of these interventions the central bank has done, to help catalyze growth within the real sector, that's in addition to some of his monetary policy mandate. So I think one of the first steps that the central bank felt, critical was to, use some of those facilities, because if you look at the communique that came out from the central bank last week, it was more or less addressing some of those intervention funds and how much of forbearance the central bank can give. We're hearing about extension, of moratorium. We're hearing about, an additional fund, I think about 50 billion, for the healthcare sector, and some other, announcement of stimulus, maybe coming out of the Bankers Committee meeting, which had over the weekend. The Monetary Policy Authority cannot do it alone, truth be told, and especially in our climate where the transmission between monetary policy tools and the real economy sometimes is not as potent, So I consider the monetary policy, as having some form of restriction, unlike, if you look at what's going on in the US, where government has announced over $1 trillion, dollar of stimulus, where US Fed has said they are ready to buy as much, securities as available just to pump in more money into the system. The impact we see when so much money is pumped into our own economy is not as, potent as the traditional, theoretical economics suggests. So that's why I believe that whatever approach we must apply, they must be tailor-made. We can't take economic theory, hook, line, and sinker, and want to apply them, in this challenging time. There are studies that have been done that can help to assist on which of the, areas will have, much more impact. And we can have some of this conversation. But I think that the central bank has, done its bit, but there is limit to what monetary policy can do.
Now, in all of these, have you seen any kind of synergy between the Monetary Policy Authority and the Fiscal Authority?
So again, if you look at some of the communications coming from the, from the central bank, and you compare that with what the Fiscal Authority is doing right now, one of the things that the Fiscal Authority has done is to announce a reduction in the budget, because clearly the oil revenue sources are going to be significantly affected. Even non-oil will be, FIRS, released some of the revenue they got for, so far in the year. And we had shortfall. I think they were only able to meet about 50% of the target. So this crisis is not just going to affect oil revenue. It also have impact on non-oil revenue. Perhaps the synergy I will see now is the announcement by the central bank that the official exchange rate, has now been moved from the 305, the unrealistic 305 that it has been for more than 4 years.
They said they were going to do that.
So what we have had now is we've seen that movement from 305 to 360. What that means is that there will be more money for the state government. Oil revenue is now low. We're talking about oil price at $26. For a country that produces, the cost of production is between 15 to $17 per barrel, according to what the GMD of an MPC said. So take $15 to $17 from $26. What do you have left? So revenue of government, coming to the government will significantly shrink. So this exchange rate movement puts more money in the hands of government, perhaps to be able to address some of these critical issues. In that, maybe there's a little bit of synergy that I am saying.
All right, now, so what are your expectations on policy? Parameters, we have the MPR, the CRR, and of course the liquidity ratio.
Well, I don't think we should see much changing in this MPC meeting. Remember that in the last meeting, that was when the MPC announced an increase in the cash reserve ratio from 22.5 to 27.5. created a little bit of tightening in the system already. Now, this time around, when we have some of these issues coming up, we don't expect additional tightening. If we like, maybe more of easing is desirable. But because of the potency of most of those tools, so look at NPR, for example, a reduction in NPR may not do as much, as we know that the government, the central bank can always achieve any objective that it wants to achieve. So I don't think that anything will change. CRR to remain, NPR to remain, and then liquidity ratio as well.
All right, we'll wait and see what happens. In any case, most of the central bankers elsewhere are bringing down their rates. So let's see what the CBN will eventually do. Thank you very much, Robert Omotunde. Robert Omotunde is the Vice President, Investment Research.